Have you recently received letters stating you owe a large sum of money to your second mortgage lender? Are you surprised to find out that years later, your second lender is trying to collect a payment from you that's 3 times, 5 times, or even 10 times what you thought you owed? It is very common for a second lender to quietly wait years, or sometimes even 10 years, to notify you that you owe them money, all the while they're racking up large balances of penalties and fees against you to their benefit. In fact, most individuals only learn of this balance when they try to sell or refinance their home. It is true, they can block the sale of your home, stop you from getting lower interest rates, or even worse, take your home in foreclosure and strip you of all of your equity that you plan to use in retirement. If this sounds like what you're dealing with, please know that you have rights. Here are the top 3 rights or things to consider. Number 1, making a demand on your servicer to identify the chain of title, servicing history, payment history on the account. This is crucial because these notes change hands so many times, and a lot of them stem from toxic or bad loans from the last mortgage crisis in 2008. You have rights as the borrower to make what's called a qualified written request or a request for information pursuant to Regulation X and RESPA, federal statutes designed to protect you, the consumer, in understanding the servicing history of your loan. Number 2, knowing the difference between a charge-off and a write-off. Many clients faced bankruptcy as a result of the last financial crisis, and their bankruptcy attorneys either did not properly explain or failed to pursue a lien strip of their second mortgage when it was underwater. These clients thought it was handled and out of their life. Now, a write-off is when it is stripped and the lien is gone and nothing left for the servicer to pursue against your property. Yet most of the time, it was actually what's called a charge-off. And that's when the lender or servicer has stopped reporting on your credit profile and stopped collection efforts completely. Obtaining a discharge in bankruptcy prevents the servicer from harassing you, collecting against you, and reporting on your credit. However, this does not always happen, and you can sue your servicer for violating these bankruptcy protection laws. Number 3, they are required to send periodic mortgage statements. Lenders and mortgage servicers are required to send periodic mortgage statements under state and federal consumer protection laws. A lot of second lien mortgage holders fail to do so for years in violation of these laws, and you have rights to call them out on this and or seek monetary damages in state and federal lawsuits. At Equity Legal, we initiate pre-litigation demands after doing a thorough assessment of the servicing of the file and reviewing responses to RFIs or QWRs presented. If we're able to use this to work out a resolution of your second lien first, we do so. And when they do not play ball, we can file suit to protect your equity. So here's what you have to watch out for. Perhaps you've tried to call your second lender and negotiate them out yourself. You become frustrated, unable to get anywhere. You know the drill. This is quite common to get caught in this endless spiral of no help, or worse, no clear answers. Or the servicer tries and push you to refinance with a lender that they have a financial interest in for a maximum amount of the debt with inflated late fees and penalties. Or even better, you finally get through after submitting lengthy loss mitigation applications and you receive a 1% lien reduction off of their inflated balance, or they ask for a temporary payment plan or a lump sum followed by monthly payments to avoid foreclosure for a short period of time with no decision or guarantee of any reduction or resolution of the lien itself. Let me tell you a story about one of my clients. They had already went through the nightmare and fear of losing their home in 2010 as a result of the 2008 financial crisis with Bank of America. They had to file lawsuits and spend legal fees to protect their home and get a modification and reduction of principal. They were even assured that the second lien was gone since the property was underwater. They spent hard work and perseverance to get back on track financially and develop equity in their home. 10 years later, out of the blue, they start receiving letters, harassing phone calls from a second mortgage company with inconsistent loan balances. They ignored it at first until foreclosure notice was recorded against the property. That's scary. It brought back nightmares of what they already went through in 2010. So the client hired our firm. We went through our process to evaluate the servicing history, We identified inconsistent payments, lack of statements for a long period of time, and conflicting interest rates charged after we served the request for information. Ultimately, we had to threaten legal action and stop foreclosure proceedings, and we were able to work out a resolution of the lien by way of a short refinance. So let me tell you how Equity Legal can help you. We are experienced foreclosure defense attorneys, and we've been specializing in these specific cases over the last few years. We've learned that when you have an attorney contact the second mortgage lender, they are more likely to respond. The last thing they want is for a lawsuit to be filed. Why? It's simple. Lawsuits cost these lenders money, and it's money that they're after, isn't it? That's why we use our expertise to evaluate, diagnose, and flag servicing errors and violations to substantially reduce the amount that you owe and protect that equity in your property. If this sounds all too familiar and it's something you're currently dealing with in regards to your second lien, please take advantage of our consultation by filling out the form on our website. Provide a brief description of your situation, and then a member of our team will schedule a consultation with you and help you protect your equity.